Welcome to the Thursday Chat with Chris. We've been doing this for a little over a year now since COVID hit. And I'm just trying to bring relevant and current information on different financial topics on a weekly basis to you all. And in an effort to provide value to you so that you can make informed decisions. In the education process, we're of the belief system that it's always ongoing. With that said, one of the things that we started to implement last year was a market monthly update, right? So what we're going to do is evaluate and go through some of the charts that we've presented in the past. And then if you have any questions, send those to the advisor that invited you to this call, or just email me and I'm happy to explain. So without further ado, we'll go ahead and get started. This is for the month of February, just a 1 month snapshot. And you'll see a bunch of squiggly lines from left to right. So from the end of January to the beginning of March, you'll see that the leader was actually commodities, which is predominantly oil. Now, if you joined us last year, you'll know that an oil-based commodity index really got the beating last year, right? Because a lot of the travel industry, airline industry, cruise industry, a lot of the folks that use petroleum just had no need. Well, as the economy starts to open, you can see that for the month of February, that was actually a leader. Followed not far behind was small caps. And small caps, for those of you not familiar with the term, are small businesses. So your smaller companies, in your community, these have the most risk. They can make a lot of money, but they can also are one of the quicker ones that can get hurt in corrections. But the next three indices had a decent month, right? So we have real estate, we have the S&P 500, which is a market weighted cap top 500, which is the red line. And then the green line, which is developed countries, right? So those are your European nations. Followed by emerging growth is typically China or underdeveloped countries where corporations are starting to emerge. So basically, February was a positive month, except for gold. Right? Now, gold last year was absolutely a leader. This makes sense because, typically gold is a flight to safety, right? And you also see on the income portfolios that, treasuries and things where, people, if they get spooked, will move their portfolios over into these types of vehicles. But gold is actually down for the month 6%. Now, the next slide is for 2 months, right? So now we're starting from the end of December to now the beginning of March. And we will see that, again, commodities, oils, as the economy starts to open up, there tends to be a little bit of optimism in the marketplace, right? Did really well. For the first part of this year, we're in excess of 15%. Not far behind is the small cap. So it's very similar to the slide I just showed you previously. And then in that small range there, you have the other four indices, sectors, asset classes. But again, you can see that gold has not been a favorite right now leading into. So that's why, if you invested in gold last year, now it's starting to give back some of its gains. Now, this next slide is a slide that's a little busy. And I think it bears explanation, whether you've heard it or seen it before. I think it's always a good idea to help interpret what this is trying to say. So it's called a bull bear indicator of one index, which is the S&P 500, which is the red line right here. So the red line from left to right did for the first 2 months a little less than 2%. And that is, again, a market weighted cap. It's one indice, but it is a measuring stick or a measuring tool that we have used. And a lot of times when you pop on CNBC, you'll see a lot of reference to, right? So it's one of the indices that's often touted as the market or everything's going, up or down, right? Because remember, the media feeds on news and, they always will write one thing or the other in an effort to either tout greed or inspire fear. That's what the media typically does. And, being able to interpret this data in a meaningful way takes a little bit of practice. And again, it's not an end all be all. It is just a gauge to say, hey, what's going on right now as a pulse check? So if we look all the way to the left, we'll see a red line. And then I'm going to tout this top indicator is called an RSI, right? So this is what we call sort of like our three wise men. So this indicator right here is the first one. So all the way across the top, this line going up and down is the relative strength index, right? And then this middle one is moving averages, right? Moving average crossover. So what that means is when the short-term moving average crosses over into over the long-term average, it will create a green line. So right here, when this happened, was a trigger, right? And you'll see this, well, it won't create the green line until all three triggers happen. But this crossover point was significant because right here is when COVID hit, right? And it was a head fake. But then this bottom index is called the MACD, or moving average convergence divergence. Now, they're fancy terms, used for technical indicators, but basically what it's saying is, listen, when all three indices cross over and say, hey, listen, start to give us a signal that we are in negative territory, right? So back in 2000, we remember internet bubble burst, right? This was a sign, one of our alarms went off that the S&P was headed for troubled waters. And it turned out to be right, because you can see that all the way down for 2000 to 2003 until it turned, right? And when all three indicators went green, we had an upward trend. That's in a perfect world on how it's supposed to operate. But sometimes we will get head fakes. It will trigger, but the market still might head up, right? Which is what happened in, late 2006, and eventually it turned green, and before the housing bubble burst. And this indicator turned out to be accurate again, and it went south. We all remember that pain, right? And then fast forward, we've been on an upward trend, right, until about 2000, midway through 2015. And then we had another signal that said, hey, listen, but it really was more of a head fake. Nothing really major happened here. And it has been continuing upward in an upward trend. The point of observation here is that right now, signs are still bullish, right? This is what they call the golden cross, right? That right now it's basically saying that there's clear skies ahead. There seems to be an upward trend in the equities marketplace for the S&P. So there's no alarm bells going off right now. However, as we get over into the income sectors, income generated type vehicles, bonds, things of that nature we're going to go into. But you will see when we get to that bull bear chart, we have some different concerns. So that being said, we can see that the month of February was not really attractive for income portfolios, right? Everything for the month lost money, with the leader, right, being the 20-year Treasury bonds, and then the next one on a negative scale was the 7 to 10-year Treasuries. And what does that mean? Treasuries are considered the safe money, like the risk-free asset. And we're going to start to talk about that over the next couple of weeks. For those of you that are my clients, know that we've had conversations. I've had concern for several years now about bond portfolios, which is why we've had Mark DiOrio on the last couple of weeks talking about other alternatives for income. But whether we use that strategy or something, we should at least know, right, as the world is starting to hunt for yield. I'm going to start to do a little bit deeper dive into what some of that nomenclature actually means. But just understand that, the red line is U.S. aggregate bonds, right? And then the blue was the leader, though. That's high yield corporate bonds, right? So high yield is, you can replace the word high yield for junk, right? When we're going to get above average return, you're a creditor, you're going to lend money to a corporation. And when they are paying above average yield or rates of return on borrowed money, that means that they have an above average risk in the form of typically defaulting. Now, you can see that they're all within that -1.5 to -2.5. So, each of those are, the same thing, right? We're in the U.S. aggregates, right? So U.S. corporate bonds, so lending money, right, to U.S., corporations right now did not pay a return. It was risky. You lost yield. So as we continue through a 2-month snapshot, we can see that everything lost money again, except high yield munis. High yield munis means that, okay, governmental was just above zero, but for all intents and purposes, the income markets did not play well. And then again, I draw to your attention the 2 month snapshot of the 20-year Treasury. Now, if you recall from last year, if you were on my calls, Treasuries were leading the way. And I just saw an article today, and I'll start to highlight it going forward, where we are absolutely at the end of a secular bull bond market. So, this safe money that is always touted as a risk-free asset, which is governmental securities, now just hit negative 20%, right? So it's just really concerning that people that went there for a flight to safety, is it really safe? Now, the government's always going to be safe unless we, go into a depression and, chaos. And that's not on the radar. But again, where we go to put our money, we're constantly evaluating. Just because something happened in the past and was the way to do things in the past does not mean that that's the way to do things in the future. So as we look at this indicator, the bull/bear indicator for aggregate bonds, right? And this is US aggregate bonds. So as we look at that, again, we've been on this bull run for almost 2 years. Well, right now, 2 of the 3 for the month of February show that we are going to start to see a reversal. And we don't have a red line yet. Maybe for next month, you will see that, which just starts to run the risk. Anytime you see a red line, we start to see people that are heavily laden in bonds in their portfolio because they've generated some type of income portfolio. And as you understand, part of my expertise is, helping folks get not only to retirement, but through retirement. Imagine that we put money into these vehicles, whether they be target date funds, muni bonds because of their tax advantages, things of that nature. But people don't realize you can actually lose money in the underlying security. And that's what this is demonstrating. So, we just issue a caution. I continue to issue caution that we need to start to think about bond alternatives for our portfolios. How do we do that? How do we, not have all of our risk in equities while simultaneously having a balanced portfolio? And again, that's part of the presentations I'm going to do over the next couple of weeks. We're going to do things on, I've talked about milk cow, and I have a slide deck put together for that. But as I started to build this out, I started thinking to myself, you know what? There's a lot of nomenclature that just gets confusing around the world of finances. So I'm going to start to take us through conversations of risk, systematic risk, unsystematic risk, before I get into the stocks and bonds. And then we start to talk about total return. Then we start to talk about income and how to balance these portfolios. And then I can have intelligent conversations with you on bond alternatives, which we've started to sort of cart in front of the horse when I talked about structured notes and maybe an ARCA addition to a portfolio, but it needs to be thoughtful in its design. So I just am sort of setting the stage that the next couple of weeks will be these topics. So just make sure you continue to join us. So this is the last slide, and this is an indicator that was actually created by Formula Folios, now Brookstone. And it's called the Recession Probability Analytical Tool. And it just sort of, it's taken 100 different, metrics or areas of measurements, and whether it be, a gross domestic product or unemployment rates or housing builds or data. And it takes all this data and it gives it, an assignment between 0 and 100. And it says that, hey, listen, anything below the 50 percentile means that we are relatively in a good non-recessionary area. And you can see on the slide here that, last year, right when COVID hit, there was a lot of concern, and then it corrected and it's been down. We were actually down from January. So from month to month, it is saying right now, the tools and measurements, if we were flying a plane, the altimeter or the radar is saying that right now, viewing bar some global or maybe some domestic terroristic threat or something like that, that right now it seems to be clear skies ahead. So again, I'm optimistic in the equities arena. I'm less so in the income in the bond arena, and that is my professional opinion for this week and this month. So that is our weekly update, our chat with Chris. We're going to invite you back next week. I want to thank each and every one of you for being on the call each and every week, showing your support. Don't keep this a secret. And if you have questions, right? So I got to show my CYAs, right? So the first of all, disclosures, right? So for compliance purposes, that all this stuff has been run through compliance. And then ultimately, if you have questions for us and you'd like to reach out, whether reach out to the advisor that invited you to the call, or if you'd like to turn around and reach out to me personally, I'm happy to have a conversation with you one-on-one. So, this is a constantly changing arena. We cannot have knee-jerk reactions, and part of our roles are to help manage emotions so that we can make informed, disciplined decisions as we go forward to help not only get you to retirement, but through retirement. I want to thank each and every one of you. Stay safe, and if you need me, I'm only a phone call or email away. Thank you. Bye-bye.